One of the exercises that investors like to do, particularly those of us who have the strategist title, is think about what might sneak up on you in the coming year. You sort of tend to think of a benchmark scenario and then look for other things that could upset the apple cart. It's an old time-tested way of thinking, and for the most part, it does work. When I was actively trading all the time, one of the things that I was really focused on was what might blow up our model. We had a model that worked really well. What could come up and sneak up on us? What sort of outlier events on the positive side, a takeover pretty much would be the ultimate one for an individual stock, or what could go wrong, beyond, let's say, the normal earnings scenarios, but more market moving type of stuff, an event that would have like a major correlating of either decorrelating events or major correlating events. And so I'll probably come out with a few more of these as time passes. But one of the outliers that I've been looking at is what might happen with some of the outliers on the credit curve. And we could talk about CLOs and leveraged loans and things of that nature. We have done some work, and you've seen me allude to this before, about using the junk bond ETFs kind of as a confirm or deny proxy for the broader equity markets. And while there had been some times where something like an HYG or a JNK had underperformed, SPY, keep it ETF versus ETF, for the most part, they really have not shown any major signs of cracking, and junk bond spreads seem pretty good, at least as measured by those two big ETFs. But what I've started to look at is a little bit further down the credit quality scale. One ETF that I've been watching is BGB, which is a Blackstone GSO fund that holds a lot of lower quality and CLOs and leveraged loans and things of that nature. And that's really failed to perform along with the market, and it's really shown some major underperformance vis-a-vis a proxy like SPY, or even the better quality junk bonds such as HYG. And I have to kind of wonder why. And there have been some rumblings. Around Thanksgiving, there was an interview with the Dallas Fed chair, Kaplan, who said he's starting to worry about credit quality sneaking into the investment thesis in a negative way. This is not me saying that there's a junk bond apocalypse coming, but one of the things I like to think about is, have financial instruments had their day of reckoning? And what I mean by that is pretty much every major financial instrument goes through a period where it gets shaken out. And stocks have had various shakeouts over the years. But you look back and see things like mortgage bonds had their shakeout. They were very popular in the 80s and then kind of got shaken out in the late 80s, early 90s, and then found their new footing. What happens is there's an experiment. People don't really know what's going on. They haven't, their scenarios work and they tend to be adopted very well, but they really don't have that stressful moment. We saw that a lot with a lot of the products that were popular in the 2000s, in the first decade of the century, and that all came to a head 2007, 2008. And so my worry now is that we may be at that point with a lot of the leveraged loan products. So I can't tell you when it's going to happen, but I can tell you that it's likely to happen at some point, because every financial product that I can think of has had a period where it's had its reckoning, and these things are usually not perfectly contained. So that's one of the outliers I'm looking at. I'm not raising a red flag here, but I am putting that on my radar, and I'd like you to put it on yours, and worry that if there's some stresses in the real bottom end of the credit quality scale, or you start to see, let's say, triple Bs and that kind of higher quality junk start to slip into lower quality territory, that's when you may start to see some contagion, and that would be the kind of thing that I would be looking for as a potential warning sign in the year to come.